The movement of prices in the gold, silver, and platinum markets has been head scratching over the last 2 or 3 months as we've seen prices soar. People get excited only to watch prices retreat back to where they were. Each time this happens, I get more messages from silver bugs in particular admitting that they caught FOMO, got sucked in, and bought because prices rose and they fear that it would be the last time of seeing these low prices. I mean, hasn't this happened to all of us? What was going on the last time you caught FOMO? Let me know in the comments section. Regardless, stick with me and I promise you will know exactly what to do next time you catch that feeling, as well as what to watch for so you can determine if a rally is real or simply a bear trap. I hate to say this, but the price jump at the end of last week actually made me mad because I'm loving cheap gold and silver. Because based on the fundamentals and technicals, I don't believe it's time for the market to really take off anyway. It feels like one of those moves to drive prices up, suck in the average investor because of FOMO, and then take profits. When it comes to FOMO and investing, it's like Lucy and Charlie Brown all over again. Before I jump into sharing what you really need to do and watch for, we have to take a moment and talk about the F in FOMO, because none of what I'm going to share in terms of technicals or fundamentals will matter if you can't control your emotions, or what we call the X system around here. Now, we all know the F in FOMO stands for fear, and what we really need to discuss is the power of fear, as it is one of the most powerful human emotions, right there with love. For as much as we've experienced fear, be it from watching a scary movie or being in a scary situation, fear of clowns, certain animals, dark alleys, or just the fear of failure, we've never really taken the time to understand fear. Sadly, we're taught to avoid fear or fearful situations, but we're never really taught what fear really is. Going forward, I want you to think about fear as your body's early warning system. Think about it. We typically experience fear before something happens, because when something does really happen, we either revert to fight or flight, which aren't necessarily all about fear. Life and my degree in counseling has shown me that fear and the feel of failure are emotions that we actually need to experience more, and dare I say, more and more. What started me down this road was a conversation I had with my 8-year-old Saturday night in the Target parking lot about success and how failure, or the fear of failure, can keep us from being the best versions of ourselves. Once you start to see fear like an early warning system, you then have the ability to utilize the positive effects of fear, which there are actually a really good number of them, such as the ability to heighten your awareness, optimize your strength and your behavior, even allows you to exceed your normal physical abilities, enhances your intelligence, and it can even make you more courageous, as long as you prevent fear from controlling you or your actions or causing inaction. In this book, Courage is a 3-letter word, the author talks about how you can't have courage without taking action in the presence of fear. And not to ruin the book, but he pushes that courage is a 3-letter word, and that word is yes. By now, I'm certain some of our newer members are probably wondering what the heck is going on and what does this have to do with stacking? Well, one of the main tenets I preach is that you as the investor are far more important than the investment. And I believe in order to be the best investor possible, it entails being knowledgeable as well as being the best version of you, especially when it comes to managing you and your emotions. Remember this diagram of emotions and thinking or cognition? The higher one is, the lower the other one goes. If you allow fear and other emotions to drive your thinking and your actions, the knowledge you have is worthless. This is why we intellectually understand the concept of buying low and selling high, but the research shows that most investors do exactly the opposite. Many of us will spend an extra hour driving around town to save money on holiday decorations, but we won't buy the supplies the day after Christmas when it's 80% off in anticipation of the next year. Unfortunately, not too many people had any intention of buying silver when it was around $19.50 on Thursday, but when it reached almost $21, they couldn't help but buy. For some interesting reason, we completely understand the idea of buying things when they are discounted or on sale, but when it comes to investing our money, we find it hard to buy assets when the price plummets. We don't see it as being a discount or being on sale for some reason. The fear of losing money or making a mistake makes us fearful and causes inaction. Instead, many people wait for price validation and confirmation before they're willing to act, which consequently results in a greater chance of you waiting too long and falling victim to FOMO. In reality, if you've done your research or homework, you don't need the short-term confirmation of higher prices to validate your decision making. We all know where metals will go. I'd say there's an 80-90% certainty. So the most important thing you can do to prevent FOMO is to start to view the market in terms of value, not prices. Therefore, the lower the price goes, the more valuable it becomes to you. The more valuable, the more you want to acquire it. As a result, price spikes actually make me want to accumulate less because I'm getting less for my money. Next, I need you to remind yourself, especially on big price movement days, that markets don't go straight up. For the right reasons, prices can fall off a cliff, but when prices spike straight up, they almost always give it back. Think back to earlier this year in the Russia invasion. Gold prices in particular spiked up, and what did the market do? It took it back and even more. So before we move into the market indicators and what to watch, I often talk about not catching a falling knife as a reminder to let prices fall, hit the floor, hit the bottom, and then start buying. Now it's time for me to remind you of the flip side. We're not dogs chasing bumpers on cars around here, not knowing what we would do even if we caught up to the car and got the bumper, meaning we don't chase price spikes. If you're finding value in this video, or if you'd like to support my effort, this content, or Stackers University, could you please do me a favor and hit that like button? I know it doesn't seem like a lot, but it means the world to me, and it helps encourage YouTube to share this content with more people. Thank you very much. Let's review these market variables and the reasons why I believe this latest spike in prices was not a market rally. Instead, it was a rally seeking to move the market. So here we have a table, and basically it's straightforward. What happened and if it's bullish or bearish. And so we saw that the Fed increased rates by 75 basis points. And then Powell indicated that they were starting looking at data and the impact of previous hike. And all of a sudden, people started feeling like that was a dovish pivot. He even said, if we over tighten, we have the tools to support economic activity, referring to lowering interest rates. He also said that at some point it would be appropriate to slow the pace of increases. He also made some other statements that were kind of interesting. And quote, to be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive. And so then you kind of got these mixed messages, but the market wanted to hear it as a bullish sentiment, but it's really a mixed message. And then Powell indicated that rates would have to exceed previous estimates to around 5%, clearly a bearish indicator. China signaled that it may ease its COVID-0 policy, but that's unconfirmed. But the market took it as this bullish sentiment. We had October job reports, which had, again, mixed findings. And so we had higher unemployment, but we also had higher job gains. So that was a mixed message. The 10-year and the 2-year bond inverted, as well as the 10-year and the 3-month bonds. And so that usually is an indicator that we will have a recession, and it's pretty reliable. And while it's reliable, it doesn't mean that's going to happen overnight. Usually there's a lag up to around 12 months. And I gotta see that as neutral because we already knew that we're likely heading into a recession. So this wasn't any new information. Recently, there's been a lot of discussion about central banks and how much gold they've purchased, and they have purchased a lot, but they've been purchasing a lot for the last 10 years almost. And so this isn't really anything new. And then there's a Dixie, positive or negative, depending on the day, but we don't know what it's going to do. We don't know if it's topping and heading lower or if it's going to catch its third or fourth wind and continue to go higher. But we know it's been having a direct impact on metals prices. And then there were reports about short covering by future traders, which contributed to this rally, which is kind of a bullish sentiment. So taking a look at this chart, I want to warn you to resist the temptation to go down the bullish column or down the bearish column and treat it like a bunch of tick marks that you can add up and see where you are, because each of these variables have a different weight or level of impact. The biggest point I want to make with this chart is to show you that fundamentally, nothing really changed in the market. And if we agree on that point, then the question simply becomes, what drove the markets to have such an extreme response to warrant the price increases? From where I sit, it just doesn't make any sense. Based on everything, here's my best guess of what we know. We will experience a recession within the next 12 months based on the bond yield inversions. If the Fed only raises 50 basis points in December, expect metals to take off, as that will be the signal to some folks in the market, even though it may be premature. This Thursday, we have some very key economic data coming out. Specifically, we're going to get the consumer price index number, core CPI for the 12-month change, and initial and continuing jobless claims. Friday is a holiday, and traders typically do not like being long going into a 3-day weekend. So if those CPI numbers come in lower and jobless claims come in higher than expected, buckle up because we will absolutely see metals take off. And that actually should be a real rally. Otherwise, expect a sell-off which could serve as a buying opportunity. Then the question becomes, can you wait to buy until Black Friday or do you take advantage of it now? I want to be clear. This is how I view and how I'm playing the market because of right now, we're kind of in a no man's land and the metals haven't really declared their intention. While I'm doubtful that we will see 1620 gold or $18 silver, my suspicion is we can expect 1650 gold and high $19 silver. So what to watch for in the short term? Regardless of all the doom and gloom videos, actually the economy isn't as bad as they would leave you to believe. Now, don't get me wrong, I'm not saying it's in good shape or that it won't deteriorate because it absolutely will. It's just not going up in a blaze of fire in the short term. Next, gold needs to close above 1700 on the upside or below 1650, which will give us a better indicator or confidence level of which way the prices are going. For silver, we need to see a close above $21 for a bullish scenario and below $20 for a bearish scenario. And here's what some analysts had to say. Quote, "This is most likely a short squeeze type of rally that should be sold here. It's too early for gold to move up. The Fed is not finished yet." So going forward, what am I watching as my long-term indicators? 1, a true Fed pivot. 2, the Dixie to actually pull back to somewhere around 100 or 105. An actual recession, black swan event, or that gold actually joins the party silver is starting to throw. Until one of these things occur, I wouldn't expect a legit rally in the market. Regardless of my position, reasonable people can agree. But what's important is that you understand the root of FOMO and you learn to control that emotion or that fear and instead learn to look at the indicators to help you determine whether what we experience or are experiencing is a legitimate rally or just another bull trap. In the comment section, I want you to answer this. 1, did you fall victim to FOMO with this last rally? 2, what are your thoughts about learning to harness the positive side of fear, something that we don't always talk about? And 3, what are the long-term indicators that you think are the most important and why? Thank you for being my A+ students and making it all the way through this video. Always stack smarter, never stop learning.